Today, we've got the pleasure of having my friend George Salas on. He's the CEO of Empress Capital, a maestro in short-term vacation rentals, and a veteran in real estate investment. George's journey has been about transforming lives through real estate, from aiding distressed property owners to empowering new entrepreneurs. He's a firm believer in financial freedom and the joy of successful investments. Outside of the office, George enjoys soccer, family time, and his Peruvian roots. For more on his insights, check out georgesalas360.com and get ready for a great episode packed with lots of valuable insights. So without further ado, let me bring George on. Hey, what's up, brother?
Hey, brother. How are you, man?
Oh, we're doing good. Absolutely. We're really excited to have you here. Yeah. What we usually do to kick it off is just have you give your kind of background story to everybody and how you got to where you are today.
Oh, absolutely. I'm ready. Let me know when we can go.
Yeah, take it away.
First of all, Matt and Mark, it's a pleasure to be here with you today. So thanks for inviting me.
Absolutely.
Super excited about sharing some golden nuggets about short-term vacation rentals here with everyone. So yeah, a little bit about myself. I'm a 6-year short-term rental operator, and my journey really started when I was 6 years old. So I'll take us through a 5-minute journey about how I came to be where I am today. So I was 6, parents were getting a divorce. This is Lima, Peru, right? And we had to fly out with my mom to a different city. And it was a small town. We were actually moving away from my dad, and my parents were getting divorced, right? So we go and live in this adobe house for 9 years, okay? So adobe house, and then half of that house had melted because the roof had collapsed. So we didn't have a living room. Okay. We didn't have a dining room or a living room. So we sort of lived in one room here for grandma that was split, and then the other room was for us. And then we have sort of a kitchen, right, where we ate. So that was me growing up, and didn't see my dad for 9 years. And at the age of 15, he came back into my life. And at that time, my mom had remarried, and we got the pleasure of moving here to the U.S. And that's where our whole journey started, right? So going from an adobe house to being where we are today with private equity, short-term rentals, and just being blessed, right? So as I grew up, I went into hospitality between ages of 17 and 18. Fast forward to 25, I worked in the restaurant and service business for about 7 or 8 years. Right. And I was into a transition to do something bigger. Right. So I started a movement, right. A movement that turned into a marketing business of promotions and hosting events and doing production. So I did that for about 10 years from the age about 23 to 33. I did again in hospitality, right, but just a different area of hospitality. Right. I created events, right, from the production to the planning to the marketing and even the hosting. And these were at nightclubs and event venues. We would have events in the evenings and we'd have events at nighttime. And we would bring people together almost every single day and night of the week, right? We did one-off events for New Year's Eve, every holiday, right? With big, like our biggest one was 3,000 people. And this is, I'm talking about at venues in the city where you have 1,000 people in a venue, right? And that's, I mean, you still see that today, but I don't attend those anymore, right? So, fast forward a little bit later on, I was able to, at the age of 33, save a few $100,000 after being in this industry for 7 years, and I wanted something more. I wanted to invest in, and I wanted to become an investor, right? And so I was approached by one of the people that I worked with and for, right? He was somebody that hired us to market his venue. And essentially we had, I had some money and I had the ability to gather people together, get investors, right? From that scene, get people to follow us. So we were very approachable. We were the best in the city at the time. So we started building a nightclub, right? An event venue / nightclub. Right. I ended up putting a couple $100,000 over the course of 2 years as an LP. Right. And back then I thought being an LP was the greatest thing. Didn't really understand what it was. Right. Like we do now. So the gentleman was the GP, and then we had different LPs come in and limited partners and into the deal, and I was able to gather people, and he obviously closed them, so I was bringing people on board to put together this project, right? So, and these are people that we all knew from the industry, investors that invest in the industry. They like the quick money because they love being out there and being themselves called owners of a nightclub or a venue, right? Attracts and brings power to them. So that was an experience, right? Being an owner for about a year and a half, right? So fast forward a year and a half after we opened, we had opened in such a debt, right? That one thing that we didn't realize was that the GP of the deal actually ended up not renegotiating the back rent payments of this triple net lease where we built this brand new $1.3 million venue, right? So the landlord had taken us to court, and at about 18 months from the time we opened, they shut our doors down. So I lost everything that I've saved for 6-7 years, right? Over $300,000. All the investors lost their money, and I had absolutely no power, and I couldn't do anything. Biggest lesson there is vet the operator, right? Don't put all your eggs into one basket. Diversify. So my investing career started on a rock bottom journey, right? So, but fast forward, and it was the beginning of my real estate. How I got into real estate, and essentially that pushed me forward because I couldn't stay where I was at, right? I had absolutely nothing, right? I hadn't built any wealth or long-term cash flow. It was gone. Everything was gone I've ever worked for. So that was a wake-up moment, and I had two breakthroughs, gentlemen. One was an internal breakthrough that was telling me that I can't stay where I'm at, right? Like I'm better than this, right? And then an external breakthrough that was a friend of mine called me and he said, I need you to come to my flip, right? He had a flip here in Houston, Texas. We went to his flip, and boom, those two moments woke me up, and it awakened the giant within, is what Tony Robbins calls it, right? So there was a giant that woke up, and that was the beginning of my real estate journey. Fast forward 6 months later, I had done 15 real estate deals. Fast forward my first year in real estate, brought in about $300,000 revenue from my real estate business. Had already 10 short-term rentals, and I was doing fix and flipping, wholesaling, just really figuring out, like learning the real estate, and I was really taking action. And then that was the beginning of all, right? And fast forward now, we've done over 110 deals, 60 to 70 launched short-term rentals, but we've taken our business from launching a quantity and volume of short-term rentals into quality short-term rentals. We only do median size to about 350 to about $750,000 homes right now, and we convert them into mid-luxury properties. We maximize the revenue and income per year. Almost every property we have brings around six figures, $80,000 to about $160,000, the biggest one per year, right? And we've launched a private equity fund recently. We do single deals, we do joint ventures with our partners, and we get to hang out with Mark and Matt, gentlemen like you, high-level people in our mastermind, right? Race Masters. So a little bit about me. I mean, I went like 7 minutes, but I hope that was okay.
That was really good. Yeah. Maybe dive in a little bit on the fund that you created. What was that process like, and how's it going?
Oh, absolutely. It started in the group with me really just wanting to scale our business. So middle of 22, right, or beginning of 22, my wife and I are like, hey, how are we going to really take what we've built, right? Which at the time was decent, right? Without a lot of private capital, right? In real estate, we had a great portfolio, but it wasn't what we wanted, in the sense that it was a lot of properties, it was a lot of hustle, a lot of work, but it wasn't quality, right? So what we have today, about 18 doors, 18 houses, right? A little bit over $8 million in assets under management, right? It crushes what we had in 2022, right? At the end of 2021, right? So we transitioned and just trying to figure out how are we really going to take that next 10x step, right? So I just, I was looking in internet and I was looking at webinars, and we ran into Hunter Thompson's webinar. I saw the webinar, and we joined. And then from there, it was the first step, right? It was the commitment step, right? That commitment step that I said, I'm going to do this. I'm going to join here and figure out like, what's my next step? I didn't know I was going to launch a fund yet. Right. Made me it created the courage inside me to be able to take that leap of faith, right? Commitment creates courage in each one of us. So started the process in the middle of 22, right? Really learning how this private equity world works, right? I'm an operator, been doing this business for 6 years, but this capital raising / private equity is a completely different world. You already know that, right? So it took me 3 to 5 months of learning, right? Just really figuring out what I really wanted to do and what we wanted to create. And at the beginning of 23 this year, right, is when we really started doing the business. And it took 9 months from there to really launch, because, I mean, these things take a while, right? So as you already know, I think we've been keeping up with each other in our mastermind. Things take time, and in a great product, you've got to put together, you've got to put the time into it. So we went and got every resource from our group. And if it wasn't for Race Masters, we wouldn't have been able to create this, right? So we launched our first $10 million fund focused on median-sized short-term rentals, the same model that's been successful for us over the last 3 to 4 years, right? And we just we're in our first round right now, doing very well. We're working on the marketing, and things are going well. Like, we've put together an amazing product that we're super proud of, right? So we're just ready to go and launching with a lot of speed and momentum into 2024 and ending the year. I've done 10 deals outside the fund this year, 10 short-term vacation rentals that we've acquired, most of them through creative finance. So
Nice.
A little bit of that. Yes, sir.
So excellent. So we're hearing from a lot of capital raisers in this environment that we're kind of in a weird spot right now, that it's harder to raise capital than ever before with elevated interest rates and that sort of thing. So what are you seeing out there as a capital raiser yourself?
Yeah, absolutely, Matt. I'm seeing a little bit of uncertainty, right? We've gone through a couple single races, where the money just is coming in, but it's coming in slow, right? People are a little bit uncertain about the environment, the economic environment right now. I mean, we're going into an election year here in 12 months. I mean, the next month we're going into the election year, but we're 12 months away from it. And I think there's going to be even more uncertainty into 2024, even though the interest rates just got lowered a little bit. I think this week, I read some news about, lower interest rates, and there are predictions that the interest rates are going to lower even more. But it is a little bit harder to raise capital right now, and people are uncertain, right? We work with fund managers in our group, and then they themselves are like, man, it's just 3 to 4 times harder to raise capital than 2 years ago, right? So we are diversifying in a way that we market to raise capital for our fund, right? So we're working with not just fund managers, but also different groups of retail investors, right? So now, given that, we're going to see, as we're just in the beginning stages, how all that unfolds. So super excited, and at the same time, when you're taking that leap into the next 10x step of your life, it makes you nervous. And if you're not nervous about something, then you're doing something wrong, right?
Yeah.
So that's where we are right now.
So speaking of deal flow, for instance, because I'm completely unfamiliar with the short-term rental space. Well, I'm a recovering Airbnb host. All right. I did it basically by accident, and to have a place for my in-laws. We had a baby, and they want to stay in town for longer periods of time. So we, created one of my apartments into one. Right. So I hate to use the term like buy box, like what's your buy box? Because for me, I'm out there, I look for problems, and then I draw boxes around those problems. But if you were to say like the type of the type of property in terms of like, what is the boxes that it needs to check when you're out there looking for opportunities, what does that look like?
Absolutely. So we have a few boxes there. I like where you're going with this, Matt. Well, number one, when it comes to our personal portfolio, my wife and I invest here locally in Houston and within 65 miles of our home, right? So But when it comes to the fund, two different buy boxes, right? So the fund itself is investing into recession-resistant markets. We're opening up different markets where there has been history of slow and relative growth in the real estate environment, which means historically between 2007 to 12, we're going for markets that had an average of a 5% growth, right, in the median price, not volatile markets or no markets that have gone negative, right? So when it comes to investing in those markets, our first buy point and checkbox in that buy box is that it has to meet the relative change growth strategy, right? It has to have had history of slow growth, not volatile like Vegas growth, right? Like Scottsdale and then a great freaking low crash, right? We don't want that. We want steady growth in our market. So that's number one. Number two, has to have the amenities that the people in that market love and want the most, right? Because love, not necessarily want, is one thing, because we sometimes give people what they want, but they really need what they love, right? Like they really need comfy beds. They need, more amenities, like the main essential amenities, a great kitchen, right? But what they love and what they're attracted by is completely different. They're attracted by the shiny object of awesome amenities outdoors, like pools and hot tubs and, large backyards. So we want to give them both, right? So when we look for a home, we're looking at what they really need. So, right, the market's going to say that we need, that the people in there, or the customers, guests, want XYZ, like pools and hot tubs, but we're also going to deliver, right, the essential amenities. So buy box number two is essential amenities, major amenities such as pools, hot tubs, or what the market wants. For example, a mountain property that most of the year is, like it's a vacation rental. I mean, a pool isn't a number one amenity. Maybe the views are, right? So that's what they want. They want to be out there to connect themselves when they're booking with being able to spend time with their families, overseeing the mountain, right, and connecting. So that's another buy box I'll say is essentially capturing the right number of guests, right, in each property. So if a market attracts larger groups, then our property in that market has to have 4, 5, 6 bedrooms, right? So a few examples like that. So we follow trends, right? And the most efficient way to follow trends, gentlemen, is to be ahead of the curve. So we see what the people in those markets love and want, and we're ahead of it because we're going to give them that plus what they know they're going to want, need, and what they love, right? So additional things. That's what's been setting us apart over the years as we've, really refined our process. And when it comes to acquisitions and as well as managing these properties, right?
Yeah, absolutely. Little follow-up question. It's random. If I can ask it, Mark.
Yeah, you're good.
So I've stayed at some of these higher end rentals, that sort of thing. One of the things that like absolutely bugs the crap out of me is like we'll rent like a multi-million-dollar home with a absolutely gorgeous kitchen, right, that wants you to cook in it, and they have like cheap Target like knives and that sort of thing, like those like super cheap like serrated knives and that sort of thing. Like, do you have like a total like specification down to like all the like little tiny nitty gritty things in all of your properties that keep that continuity and that guest experience across the board?
Absolutely. When I first started, I used to be that Walmart guy. I would buy all my stuff by myself at Walmart, right? And I was like, I'm going to save as much money as I can and get the cheapest stuff, and I'm going to make all the money, right? So it doesn't work that way, right? You get what you pay for, and people's expectations when you're charging $800-900 a night are completely different. So we have a list. It's a replica for each property, 3, 4, 5. We don't really go into 3 bedrooms much, right? We have a list and a blueprint that allows us to just go through each, right? And the only thing that doesn't have a blueprint when it comes to staging and designing a property is the theme and the vision behind that property on what it's going to look like. That is a customized approach for every single deal, right? So 100%, and that helps, right? And we've stepped up our level, our game year over year, and the level of quality that you provide, and it's also a confidence thing, right? Whenever you start something, you want to save as much money as you can. If you're not confident that's going to work, right? That's how most people think. But one thing I did forget to mention, gentlemen, is that a lot of the property we are acquiring right now, whether it's our personal portfolio or the fund, right, are through creative finance, right? And this goes against everything, right? Meaning lower interest rate, 2, 3, 4, 5%, right? Something I forgot to mention earlier, right? And it is crazy. If you want to dig a little deeper into what we're doing with these sub-twos, I'll be happy to share.
Yeah. Are there certain states that are more favorable towards the sub-2? And have you run into any states where it just really doesn't work? I know New York is not a state that's very friendly on sub-2.
Yes. I am not familiar with the laws in other states, but as far as Texas is completely legal, right? And there are a lot more nuances than what you think, right? We so far we've done like probably about 25 sub-2 deals the last 4 or 5 years, right? And 10 of them has been in the last 12 months. So regulations can vary, but for the most part, right, this strategy is fantastic, and it is legal, completely legal, and it works because you're saving not just on a down payment, which increases investor returns, right? Because you're buying a property with maybe 10, 15% equity instead of 20% equity, right? And you're getting that equity automatically built in, right? You're putting down, instead of 25% in an investment loan, you're putting down 10% or less, right, into this deal. So your returns double to triple based on just that one fact, right? Not given the fact that short-term rentals create additional cash flow, so it bumps our IRR, right, based on that cash on cash. So
what's the motivation for that particular seller that they're willing to do the sub-2? And then wouldn't they have problems if they wanted to go out and buy another house because that debt is still showing under their name?
Great question, Mark. I love it. So there are a lot of motivations behind these sellers, right? The number one motivation that I believe is they are in a distressed situation, mostly because something happened. They had an event in their life recently, and they cannot sell their property for one or two reasons on the multiple listing service, right? Whether it's like they're getting a divorce and they need to sell quickly, to maybe I bought it and then there's not enough 10% to sell a property. There's not enough equity. There might not be 10%, or the property needs repairs. They can't sell it on MLS, right? And then basically they're not willing to do cash. The sub-2 strategy is faster, right? As long as it's well communicated from the person that's acquiring it, right? And all the disclosures are done. This strategy is all about disclosures, right? Disclosure. So in our sub-2s, our closing documents are about 60 different pages of disclosures, 50 to 60. And it's page after page. Like legally, you have to disclose not all 60 of them, but there's about 4 or 5. Let me give you an example. Like you have to disclose about the insurance. You have to disclose about an underlying lien, right? You have to disclose, as a buyer, you have to disclose your seller. And as a seller, selling that sub-2 to an investor, they must also sign that they understand that. And then they have to give us these notices. So it's like it's a two-way street, right? And most people out there, 90% of them, they do not know what they're doing when it comes to sub-2s. Now they can get the deals done. They can acquire these single family or multifamily via sub-2 or whatever. But the problem lands in all the nuances and in the new laws that have been passed. Perfect example, Texas, right? They've passed a bunch of new laws, and every single year it changes, right? And then the title companies, they're a middleman that basically they're getting. It's kind of like, if you're an investor, or let me just give a different example, right? And if you're a service provider and you specialize on, let's just say, selling logos, creating and selling logos, but then you have customers coming in and saying, hey, I want a website. Now you're like, oh, well, I see a lot of money being missed. I'm going to sell websites. These title companies are taking these clients because you're getting a lot of investors reaching out for them to do the creative finance deals without having the proper disclosures and having the proper paperwork, which makes it all legal. And then they give you a disclosure for them saying that, hey, I'm just giving you the paperwork. I'm a third party. You can't come back and sue me, right? Even though I gave you the wrong paperwork, you cannot sue me. So that's the biggest problem that I see in sub-2s. What we've done is we've searched for the best people in the industry to close these deals, right? Not just get the best deals, build the best relationships on the front end, but you've got to have the right attorney, and then the attorney has to be specialized in creative finance. That's the biggest thing about sub-2s.
Are you saying the cash people aren't buying them because there's not enough equity? Their cash price would be less than what's owed on the house, and that's why there's no cash transactions? And
well, I'm not saying there's not. What do you mean? Rephrase your question.
Well, you had just said that they can't sell it to a cash buyer, so I was just curious why. Or is it just a marketing thing? Once you get them on the phone, it's more about pitching your narrative, and then they're like, "Yeah, that sounds fine. I'm going to go with it." So I would imagine if there was equity, that why wouldn't a cash buyer want to make an offer on that?
Yeah, I would say. I mean, I think it's not just about the cash buyer. I think it's more like they're not. These people aren't selling their homes because they're in a distressed state. And as an investor, if the investor comes in and this people need to sell their homes fast, right? Then a cash buyer, I mean, they buy cash. They're going to have to refinance that thing, right? And it's going to be 9% interest rate on that deal. So it's more on the smarts of the investor, in my opinion, than it is more on the seller's end. Right.
Yeah, so they're just not offering enough that makes it interesting for the seller. You can offer a little bit more because you're getting those better terms.
100%. Right. If we're closing on a 2.8% deal that I'm running right now, a 2.8% interest rate deal next week. Right. I would have never bought that if it was cash. Okay. Even if I had the loan lined up, it would have been 9%. Right. So this is a $400,000 house. There's no reason. Like sub-2 is the best thing ever created in the planet when it comes to real estate, for me at least. Right.
I got one more question. I'll let Matt take it away. So I know you were saying you want to get a good location. It's got to have amenities. Your buy box is pretty specific. If you overlay this distressed seller on top of that, that seems like it might reduce the amount of opportunities that you have, but it doesn't sound like that's the case. If you find an opportunity where it's compliant with what you're looking for, they're willing to do a sub-2, are you a little bit more lenient on the location and say, hey, we can make this work? Or are you still pretty strict with that buy box and say it's got to have the mountain view or it's got to have whatever?
Great question. So now most sub-2s are not going to meet the specific niche buy boxes. Okay. So we have to get a lot of deal flow, which we do, right? A lot of deal flow. And a lot of the sub-2s are only part of our portfolio diversification because most sub-2s are not going to be on a mountain, right? Those properties will sell faster. They're going to be in your major cities, right? And we look for appreciating markets for those sub-2s. So when it comes to changing our buy box, the fund has its buy boxes per market. So it does not change those. And how we're buying and acquiring the deals, right? How we're getting the deal flow is specific to those markets, right? So we go and connect with a bunch of wholesalers and creative finance groups for that specific market. But you have to do it basically connecting first with the people in the city, right? So let me give you an example. If we want to go to Lakeview, Austin, or you want to get deals around Austin, Texas, the people getting those deals are acquisitions people that are inside Austin, Texas, right? So when it comes to actually getting the types of deals, we are not flexible in the fund, but we are flexible when it comes to doing single deals, right? And it depends what market we're in at that time. But we do get, at least 15 to 20 deals a week, right? Which is great, but it's not exactly at the number that we need. We need like 200 to 300 deals a month in order for us to be able to underwrite and get those niche properties.
Mm-hmm.
Does that answer your question?
Yeah.
So, George, what is the targeted term for the fund? Like when are you planning on winding the fund down after you've implemented this strategy?
Absolutely. We our launch date was November 27th. We just pushed it by a month, so it's a 12-month open period. We've got different periods where we're going to be bringing in the capital, different tranches. So closing towards the end of next year. There is an option for us to be able to extend the timeline a little bit. So the term is it's a 5-year term for our fund with a 1 to 2 year extension possible, depending on how the market's playing at that time.
So high level, like what's your exit strategy on this like 5-year term for these assets?
I love that question. So we are reverse engineering a sell to an institutional buyer, which we believe an institutional buyer within the next 5 years will be ready to buy, right? And we are creating stable returns in an unstable economy by doing a couple of strategies, right? One of them is we're fluctuating our operating costs with some of our in-house fees, like the management fee. Since we have an in-house management company, we're making a tweak within our operating costs so that it stays stable, right? So we've created a way to do that, right? And our goal there is, right, we reverse engineer, we build what an institutional buyer wants to buy, right? We do it by understanding what they want. Mm-hmm. And what they want is stable returns with a growing NOI, right, that can produce the returns they're looking for. Yes or no, right? So we have a couple people in mind, a couple buyers in mind already, right? And we're basically, there's no time for us to reach out to them, but we're seeing what companies they are buying, right, currently. So, and then that's how we're reverse engineering our strategy, right? And as we grow this, we know what our portfolio is going to produce. So that's not exactly what they look like they look for. These companies actually look for portfolios because there's a lot of real estate portfolios that can perform, but some might be riskier than others. Some might not create the cash on cash return they're looking for, or the returns, right? So we're specifically tweaking our fund so that it performs to that end buyer.
Okay, so I think I'm understanding here. So typically institutional buyers, they want to place large amounts of capital, right? $500,000 to $750,000 is not going to be enough to blow their hair back on that. But like, let's say a $10 to $15 million deal of assets that have a track record of producing stable cash flows. I think it's kind of like what they're going to be looking for when this thing comes full cycle. Am I correct in that characterization?
Yes, and in addition to that, one point is the stable cash flows with the stable NOI, mm-hmm. right? And obviously capped operating costs that are not fluctuating. And the one thing about short-term rentals is that it does fluctuate based on seasonality, right? Mm-hmm. So we're looking at trends of 1 year, right? We want to because you're going to fluctuate between your January, February, up and down because of seasonality. But what did this portfolio perform year over year compared next to each other? Did it grow? Did the revenue and and then the NOI slowly grew, right, based on each year separately, or was it up and down?
Mm-hmm.
Right.
Yeah, no, absolutely. So maybe there's going to be some diversification around geographies that maybe have like a blend of like sort of complementary seasonalities, so as to produce globally a more stable stream of cash flows.
Absolutely. We invest in two out of the three. I'm sorry, two out of the three, but then we're diversifying into sub niches, right? So to give you a good perspective, you have three major ways to look at markets. You have your metro markets, which have subcategories of urban, suburban, and rural. You have your regional markets, which have mountains and lakes, right? Mountain lakes / beaches. And then you have your national fly out markets. The difference between the regional and national, or the national markets, we don't invest in national markets, are the most expensive real estate, the highest revenue, but also the highest risk and the highest volatility. Those national markets are not within our buy box, and it just speaks because they just don't fit the relative change growth strategy. The regional and metro are, right? So let me give you a perfect example. I'm here in Houston, Texas. We just purchased a deal in Cypress, Texas, right? And this market has grown an average of 5 to 6% in appreciation over the last 10 years, right? It didn't even get touched during the recession in 2007. The numbers look good, and the revenue is increasing in that market for our 6 to 7 bedrooms, short-term rentals, 5 to 7, at a rate of 14 to 15% per year. Why is that? Well, I mean, you're in Cypress, Texas. It's sort of a neighborhood in this around city of Houston, and you have all these neighborhoods blocking short-term rentals. Like literally just that you can't do short-term rentals. Then we have certain little areas that we're investing in where we're going into unrestricted neighborhoods in this market, right? So revenue is growing. There's less supply, right? The appreciation is slow and steady, exactly like we want it, right? We look for all these little factors there.
Where are you getting the data on the preferred number of bedrooms and configuration of your units for your particular markets?
We use a couple softwares, Mark. The main one, right? It's an extension of AirDNA called Tableau, right? So it is a data aggregator that has put AirDNA's data in a much better way. We're able to download the data. It's like $1,200-$1,300 a month for the software, right? So we use that. We also use AirDNA as a quick, fast, right, overseer, but it's the same data, right? The only difference is that one puts it in a different way to view it, and you're able to download easily because the data aggregator will, that's exactly what they do. So it's a partnership there. We use another tool called All the Rooms, alltherooms.com, and we use Mashvisor as well as a third or fourth idea. And then I'm sure you guys have heard of this tool, maybe not, but Matt, since you had a short-term rental, there's a tool called Price Labs that has a component of pricing and in market pricing. So we utilize these 4 tools in conjunction with each other. We just look at different, and some are going to have different data, right? So you kind of pick out the best data of each. And then the data is more about the comps, right? Can you find the most accurate comps? Sometimes you'll see, most of this data is not live. So you'll find some properties that, that maybe they were relisted or don't have, reviews. And then, that makes it a little iffy to use. So we try to look at different softwares that will pick up different data for us to make our decisions, right? So, and we underwrite it at a very deep level. Like every property goes through a very extensive underwriting at the property level before it rolls up to the fund underwriting pro forma.
Yeah. In the long-term market, long-term leases, we find there's a market for everything, right? From a studio, 1, 2, 3, 4, 5, 6 bedroom. There's a market for it. Do you find the same thing in short-term rentals, or are you saying that there might be some houses that just don't really fit the Airbnb model? For instance, a small, tiny house, 800 square feet, maybe 1 bedroom, something like that? Are those ones that you stay away from, or would you say not necessarily? If I get them for the right price, we would definitely add those to the portfolio.
I love it. Yeah, we would not get into the tiny home strategy. And the main reason, main reason for that is just too small, and we want to be in a niche where we create 6-figure revenues per every property, right? Well, our minimum is 75,000, so close to 6 figures, right? So a tiny home would bring you 40, 50, even though it would be a lot cheaper, right? Operationally, it creates more. Less efficiency, right? And more movement, more deals, more headaches, more work, more staff to hire, more cleaning teams. So we want to stay away from too small of properties. Right now, the short-term rental market has maybe 15, 16, 18 different niches, right? We want to do 1 or 2, right? 4 to 6 bedroom homes, turn these into luxury, because you could even go into a 4 to 6 bedroom home and have different niches there, right? And we look at, okay, out of these 4 to 6 bedroom homes, which one is, generating the most revenue, right? And those are the luxury revenue generators. Now there is budget, there is economy, there is mid luxury, and then there is luxury, right? There's 4 or 5 different strategies. And for us, the most efficient way has been getting the debt and acquiring these properties for less down, with a cheaper form of debt, right? 4 to 5, 3% interest rates from sub-2s. And then turning those properties that might maybe not fit the criteria of each property we're buying, but we turn around, let's say we get a property for 30 grand. That's what I'm buying the sub-2 next week. It has a pool. I take that property, add everything I needed to perform at 117,000, which is our highest comp on this property we close next week in Pearland, Texas. So when I go in there, and I might put less money down on the front end, but on the back end, I'm going to add an additional 30, 40, 50K in furniture and outdoor furnishings, right? And maybe building a deck, building a game room out in this one little garage area that we had, building a putting green with a dog little fence area next to it. So all these things make us create that additional revenue, right? So the properties might not fit what we're looking for at first, but then when we look into it, we base it more of our comps, right? So when we make our decision, we're trying to see is like, are we gonna be able to get by and create 6-figure revenues by investing 30 to 40K plus the renovation plus staging, let's say 100 grand, right? So we're still at a pretty high number, right? But now instead of, if we would have done the same thing in a 9% purchase with a retail price, let's just say this property didn't have any equity, at 9%, and we went, most people do this, most operators will go and do exactly what I'm doing, but they'll buy a higher end property that is fully retail. They'll think that because it has a pool or a hot tub, it's going to make 6 figures or 120,000. It doesn't work for them. And then they're like trying to figure out, why am I not making any money? Well, first of all, you purchased the retail and got 9% debt, right? And trust me, it is tough out there right now with 9% interest rates.
Yeah, that makes sense. Do you have problems when you're talking to LPs and they see that you're really familiar with one geographical area, and then you tell them, hey, I'm considering going into this other geographical area that we don't really have a track record or much experience? Has that been an issue, or has that even come up with discussions with LPs?
It hasn't come up so far, and mainly because it's not about the geographical area. I believe it's mostly in today's world. I mean, you can get any data for the real estate prices, right? For real estate prices, and then for the short-term rental revenues, and really just run an accurate operation. It comes down to our ability to operate efficiently by creating the relationships with our boots on the ground team, right? So because we're operators and because we know where to look and how to build the relationships and how to still do it at a cost efficient way, it has not been that big of a deal for us when it comes to talking to LPs or really just communicating that to anybody, right? When you go out there, you've just got to build the right team, and then it comes down to like how much are these vendors going to charge us, right? And can someone manage them operationally? Opening more markets makes it difficult, right? But we're not opening 10 markets in Fund 1. We're only opening 3 to 5, right?
Okay.
So, love it.
So follow-up question. Mark was trying to, dig into some potential. I mean, every investor that you present an opportunity to is going to have common objections. So Mark, was pulling on the thread of that a little bit. What objections have you been hearing in terms of common ones from your potential investment partners, and how do you overcome those?
So one of the most common objections that I've heard lately, it's been like, I don't know what's going to happen. The economy is uncertain, right? So, and this was like last week, right? I heard it again. It's like, I don't know what's going to happen. It's hard to raise capital. Like, people aren't interested, right? And my answer was, have you looked into our strategy and a little bit of a more deep than you seem to know? And we've made one tweak, right? Before we launched, or a few months before we launched, we had not added the relative change. This is like April of this year. We're like 4 months away. We added the relative change growth strategy into our entire fund strategy, and that's been a big help, because whenever you show them the research, right, that you're comparing data doesn't lie, right? So that's been one way that we've overcome some objections. I mean, another one would be, like, hey, what happens, because we're actually going market when it comes to the returns, right? So they're saying, look, George, you're showing 9 to 11% cash on cash, and that's what you're marketing on your projections, and in a 16% IRR, right? What's the difference between that and a multifamily deal? Only a couple points, right? So, but for us, we went market, right? That's what the market is offering when it comes to short-term rentals, but what they're delivering is a completely different number. Okay. The average return to the investors is 25 to 30%, but what we're marketing, or what the competitors are marketing, right? We haven't had obviously a quarter yet of returns, but what we're marketing is 16%. So we just want to under promise and over deliver, right? Under promise and over deliver. Right. So we know what the market is putting out there. We know what the numbers are coming out to, and what the revenues are, but we don't want to go all out at that number. Now, internally, when we have a conversation between us, yes, we're saying this. I know we're live right now, right? But internally, we see our partners. We're like, oh my God, it's not really that much higher, right? Than your 16%. On multifamily, I'm getting X percent, right? 10, 12% IRR, 15% IRR. It's like, it's only 1 or 2% points higher. Well, let's talk internally here, right? So that's how, don't you guys agree that that's one strategy to, I guess, mitigate risk, right? And over deliver.
Yeah.
Yeah, I think that what I'm seeing out there is, we have the risk-free rate of return, let's say, is 5.5% on an FDIC insured money market account, right? And that's a demand deposit account, so they can access that cash today if they wanted to. And back in 2017, when I was raising capital, offering a 7% fixed rate of return, when money market accounts were paying 0.02%, that was 7% was better than a sharp stick in the eye. So the two tails that kind of wag the dog is, one, we're buying commercial investment properties opportunistically. So we're agnostic to asset class, But typically we're buying from mom and pops that have owned a property for a long time. So typically a sub 2 situation is not something that's going to be viable because a lot of these people don't have any debt on the property, right? So we have to factor in higher debt costs in terms of annual debt service into our operating costs. So therefore, we have to buy the property cheaper to do that. The second tail is our investors want 9-10% in terms of annual distributions during the hold period. And so then we have to like buy the property even cheaper than that to satisfy those types of returns, right? What I have been seeing, at least in the commercial space, is I've been seeing just crazy. I mean, I've been in real estate for 17 years, and I haven't seen things get so creative from a financing standpoint in this high interest rate environment. And it's the first time I'm actually seeing buyers and sellers work together as a team to create win-win situations, such as, well, I don't want to sell it for less than 1.8 million. Well, I can't pay more than 1.6 because interest rates are 8%, 8.5%. So I've been seeing situations where the seller is like, well, okay, 1.8 is like, that's like my bottom line number. So what I'll do is I'll hold a second position mortgage at 0% interest, 0 payments, with a balloon for that balance at the end of 5 years for that 200,000. Like just crazy stuff like that in this environment. So I think that there's, people are scared, but this is where the immense amount of opportunities are created, is when we kind of have this uncertainty in the marketplace. Once we know that we're in a recession and that we've bottomed out of the recession, a lot of those opportunities are going to be squeezed out, because then people start developing confidence, getting more clarity as where the economy is going. And then you start having another bubble. Like Robert Kiyosaki says, we don't produce anything in this country anymore. We produce bubbles. So I think that that's kind of what we've been seeing out there when we've been talking to investment partners. What about you, Mark?
Yeah. People are definitely getting creative. Sellers are still hanging on for those prices, and the buyers just are more reluctant to pay them. So I've had a lot of deals that have come very, very close and then not been able to cross the finish line just from these small gaps. So I think it is important that people think outside the box when it comes to closing deals. Otherwise, there's going to be a lot of product just kind of sitting there.
Mm-hmm.
Yeah, even agents are more willing to listen, right? Especially, I mean, I get messages on Facebook and LinkedIn from agents that see my posts, and they're like, hey, it's dead right now, right? Do you have any deals or is there anything I can do for you, right? Agents are, which also hasn't happened before, where agents are willing to work with wholesalers to get the deals done for the buyers and the sellers. That's exactly how this creative finance niche has grown and became. You did not see this 2, 3, 4, 5 years ago. Everybody was like, nope, we don't do that.
Yeah.
Right. So now it's more of a team effort, right? In real estate, it's always a team effort, but there's always that difference between investors, right? And then an agent. They don't want to talk to each other. Like, I don't like agents. And then, I don't like investors because blah, 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 right? So I love the fact that there's been more of a unity in creation of a working environment between buyers, sellers, as well as agents and wholesalers, right? Which these are the investors making the deals happen, right? So, yeah, it's crazy.
So is your fund technically a blind fund then, since you haven't identified the properties that you're going to be purchasing until you've raised the money?
That is correct, Mark. We've identified markets, the type of markets by definition, but not the properties.
Yeah.
So it is a blind fund.
What did the just out of curiosity, what did the legal fees end up being for something like that? Just ballpark is fine.
Well, we had a great deal from our community, right? So I think I would have been around 18 to 20,000, but legal fees 15K. But then everything else, the marketing and everything else we built, we're at 75,000, which includes about 35,000 from the mastermind that we had to join, the conference we went to, the courses I bought to
Yeah.
learn how to build it all.
Yeah. Now, do the attorneys bill you by the hour, or do they give you like a set fee up front? They said you said, hey, this is what I want to do, and they said, okay, that's going to cost 15 grand, or were they like, my hourly rate is $1,000, and I'm just going to send you bills until I'm done?
Yeah, great question. So when it comes to creating this, syndication of fund of attorneys that we work with, essentially just create a package, and this has, your PPM, private placement memorandum, and it has your blue sky filings, right? And it has your operating agreement or your limited partnership agreement for our fund. We did it with a limited partnership and then a general partner. And it also has your general partner entity creation as well as the fund creation, right? And then lastly, it has the operating agreement for the general partner. The only thing that does not have is not included is the fees, right? So like filing fees, and so that's basically their fee plus the filing fees. We're talking about probably like $3,000 to $4,000 just in fees to create all these entities and file the blue sky and all that, right? So
yeah,
I mean, we're literally probably 16,000, and today the structure would be 20 grand all in, 15,000 plus 4,000 to 5,000 in fees.
So is that kind of like a flat rate then, or does your attorney bill you by the hour?
No, it's not by the hour. It's a package.
No, it's package. Okay.
So we have about 4 minutes left before we wrap up. I did want to end on kind of pulling the thread at deal flow as a subject. It sounds like deal flow is a bottleneck for getting in front of opportunities. You need like about 200 to 300 a month going across your desk. What's your strategy for rapidly accelerating that deal flow so you can get more opportunities to underwrite and therefore grow the fund holdings?
Great question, Matt. Deal flow is not a bottleneck, but it could be, right? And then the reason why it's not yet, obviously, is because we've built a relationship. We're not in the acquiring phase yet. So we're underwriting properties and then we're getting deals, but all we need to do is open up and then join these creative finance groups, and we know exactly who the deals are going through. There's major groups, right? So the next step would be, hey, we're ready to launch, ready to start acquiring, right? We go to join these groups, right? So this is the same way I built a deal flow in Houston, right? So I have deal flow in Houston. We just don't have deal flow in the additional markets because there's no need to spend that time. But yeah, we have a strategy there to join and infiltrate the network, right? That's how we're going to get our deals. So not necessarily farming our own deals or acquisition. We're not in the business of acquiring properties as of yet. Maybe fund two, we might build an acquisitions team. That's a long-term goal.
Yeah, I was thinking when you were mentioning communities, I was like, I went to the Bigger Pockets conference in Orlando in October, and there was like so many Pace Morby people that are there, and I was thinking like, oh geez, like for deal flow, you like join like Pace Morby's community, and then you just like hammer out the message there of exactly what you're looking for and what you're offering, because there's a lot of hustlers out there. And I can definitely appreciate, instead of trying to build out this infrastructure ourselves, let's partner with the people that have built out the infrastructure to lean on them for deal sourcing, because that's what their number one focus is. So no, that's pretty cool.
Yeah, everything I've learned has been from Pace and his YouTube, 95,000 YouTube videos, right? And his courses and stuff. So in deal flow, it's one of their strategies is that group, right? So we love everything they're doing, and that these are the guys that we do business with right now, right? The guys from this group.
Absolutely. All right. Awesome. Sounds good. We're at the top of the hour.
Top of the hour. If anybody's looking to get a hold of George, GeorgeSalas360.com. Any other shout outs you want to make before we?
You want to connect, and I've got lots of social media stuff happening out there. We've got my YouTube channel, and then our website, Empress Capital is out there. And if you want to connect, just hit me up. And appreciate you gentlemen having me in the podcast, man. Thank you so much. Hope that.
Yeah, with your background, you should probably plan your own event, right? That's got to be coming down at some
Soon,
point.
soon. We're working on it.
Nice.
Yeah,
Well, when you got it on the calendar, let us know and we'll promote it for you.
absolutely. Yeah, it's quite a bit of work to put those together, right? So it's just strategically, that's secondary, right? First, creating our relationships and our partners and building the infrastructure for those two with partners, right? Fund management partners, and then also retail investors. And then once we've built infrastructure, which we're in the process of, then we'll do our event. But yeah, I'll keep you updated for sure.
Awesome. Well, thanks so much for coming on. And thanks to everybody that tuned in. We'll see you next week.
All right. Hey, take care.